Have you ever thought, I wonder if my broker has my best interests in mind when making recommendations for me to invest? If you haven't thought of this, you probably should. 'Cause I have a little secret for you. Your broker can legally put the interests of their firm ahead of your interests.
Hold up. Wait a minute.
After watching this video, I'm going to show you that going to your broker for investment advice is like going to your pharmacist to try to get off meds.
Maybe your best course would be to tread lightly.
Hey, my name's Cory. If you're a guest joining me today, this channel is dedicated to mastering money, saving, living on less, and investing the rest. If you haven't yet, please consider subscribing so you don't miss an important video. In this video, I'm going to talk about secrets your broker might not want you to know. The first secret your broker might not want you to know is that they make money even if you don't. Imagine for a minute you want to start a business venture with a partner selling avocado toast. Your partner wants you to provide all of the startup cash for premium quality avocado. And not only that, they want you to put up all of the cash for the business in general. They want you to front the money for the most elegant plates and knives to serve your premium quality avocado toast on. They want you to take all of the risk. And at the end of the day, if the business fails, your partner still wants to get a paycheck. Investment brokers are not so different from operating under these same agreements as your avocado toast business. Commission-based compensation models used by many brokerage firms allow fees and commissions to be taken from your investments whether you make money or not. For example, your broker convinces you to buy XYZ stock at $100 per share. If the price increases to $120 per share, your broker may call you and advise you to buy more of the same security because of the 20% appreciation in price, explaining that it could continue to grow to $140 per share. If you agree to purchase more, this transaction would then generate a tidy commission for your broker. On the other hand, for example, let's say the same investment in XYZ stock drops to $90 per share. In this case, the same broker might call you and explain why you should buy more of the same XYZ stock because it's now less expensive and you're getting it at a bargain. This transaction would also generate a tidy commission for your broker. Heads I win, tails you lose. Is anyone else feeling like this is a major disadvantage for the investor? As you can see, your broker's success can have little or in some cases zero correlation with your success. This represents a tremendous misalignment of interest that may actually cause your broker to succeed at your expense. The second secret your broker might not want you to know is that suitability is the standard. Now, to illustrate this point, let's say, for instance, investment A is the best investment for you as the investor, but offers no commissions to your broker. However, investment B might not be the best investment for you. However, it pays a 5% commission to your broker. Under the suitability standard, now catch this, I don't want you to miss this. Under the suitability standard, your broker can legally advise you to invest in investment B that offers a 5% commission to them and not investment A. And they may instead offer you or even suggest to you to invest in option B, which pays a 5% commission. A lot of firms operate under this assumption, and people don't know. This major conflict of interest is actually permitted under the suitability standard. Here's another example. Let's say your broker has 3 options available for you to invest in a simple S&P 500 index fund. Option 1. The advisor's firm has an S&P 500 index fund that pays a 3% commission to the firm out of the sale amount. Option 2 is an identical fund from another company that pays 1.5% in commission. Option 3, an identical fund from Vanguard or Fidelity with no commissions at all. Under the suitability rule, your broker can legally and legitimately sell you the highest priced commission fund to them, and the suitability standard has been fulfilled. Isn't that lovely? Third secret your broker might not want you to know is that their commissions are actually eating away at your returns. If you're paying commissions on a per trade basis, you might actually paying a lot more than you think you're paying. Here's another quick example. If you're charged a 2% commission per trade and you make 3 trades per year, you're actually paying 6% in fees to your broker. That could be eating away at your returns. So if you made a one-time investment of $10,000 at age 20 And assuming a 7% annual growth over time, you would have over $500,000 by age 80. But if you paid just 2.5% in fees and other expenses, your ending account balance would only be $143,000 over the same investment period. The fourth secret your broker might not want you to know is that their alphabet soup title is actually at the bottom for a reason. Brokers may be using deceptive titles to give you the wrong impression about their compensation models and qualifications. Currently, the sheer abundance of professional designations being used within the financial services industry is confusing even to the most experienced investors. However, understanding the differences between these titles can have a dramatic effect on your long-term investment results and overall satisfaction. For example, the term financial advisor is one of the most used terms in the industry. However, many of the individuals using this title are salespeople looking to meet quotas by selling financial products that may in some cases sell non-marketable securities, which include long-term commitments, excessive fees, and high levels of risk. Now, titles with the word senior, certified senior advisor, CSA, and certified senior consultants, CSC, for instance, don't let the alphabet soup impress you. The only one that should in a financial planning profession is a certified fiduciary advisor designation. A fiduciary advisor is obligated to make recommendations that benefit you as the investor. With a broker, you're dealing with a salesperson who may or may not have your best interest in mind. On the other hand, registered investment advisors, also known as RIAs, are firms which operate under the fiduciary standard, which means that they are legally obligated to put their clients' interests first at all times. These investors get paid to give financial advice and by law must remove or at the least disclose any potential conflicts of interest to you as the client. A quick example of a fiduciary standard is that if a fiduciary advises you to buy Tesla stock in the morning at one price, and then they, later on in the day, purchase that same Tesla stock at an even lower price, they're obligated by law to give you the better price. However, don't let all of this intimidate you and make you feel like you're in over your head or you don't know what you're doing. If you've watched any of my previous videos, you know the majority of investors don't actually need an investment advisor for the reasons that I've listed, and it actually could be hurting your returns in the long term. Hey, thank you so much for watching to the end. I know this video was a little bit heavier than our normal videos. Don't get me wrong, this is not a bash Wall Street video. In the book Richer, Wiser, Happier by William Green, he says that even the most honest men can be tainted by such a compensation model. So I hope you got value from this video. Thank you for watching. If you haven't yet, please consider subscribing so you don't miss an important video, and we'll catch you on the next one.